Welcome back, it's Jason Walter here. I want to make this video for you guys today because I'm personally seeing some trends in our housing market that is very concerning to me. And also right now, as of today, which is the 21st of April, the average 30-year fixed rate mortgage in the US has reached 5.38%. And this is according to the Mortgage News Daily. Right now at 5.38%, which is pretty remarkable. Compared to 1 year ago, the average 30-year fixed rate mortgage in the US was 3.16%. So right now, mortgage rates have increased by 2.2 percentage points compared to 1 year ago. And right now, mortgage rates at 5.38%, these are the highest levels we've seen since at least 2009. Obviously, one of my concerns right now is that mortgage rates have been increasing greatly, and that could cool off home buyer demand. And CNBC is reporting that mortgage demand falls to nearly half of what it was a year ago as interest rates continue to rise. So part of this decrease in people submitting loan applications right now is due to a lack of people submitting loan apps for refis. So right now, according to the Mortgage Bankers Association, or the MBA, they actually just released this yesterday. They reported that mortgage applications decreased 5% from 1 week ago. So I have some concerns regarding this report here, so stay with me here. So part of the reason why we're seeing this big decrease in mortgage applications compared to 1 week ago is because the refi index actually decreased 68% compared to 1 year ago. And this is of course because mortgage rates have been increasing greatly. And so of course we have a lack of people refiing right now. However, as you guys all know, if you follow the channel, what I'm more concerned about is the amount of people who are submitting loan applications for home purchases. And the Mortgage Bankers Association breaks this into a purchase index. So their unadjusted purchase index actually decreased 2% compared to the previous week, and also we're down 14% compared with the same week 1 year ago. So we're seeing fewer people submitting loan applications for home purchases, at least compared to 1 year ago, and also compared to 1 week ago as well. But that's not what I'm mostly concerned about. So have a look at this. Joel Kahn, who's the MBA's Associate Vice President, had this to say. The 30-year rate has increased 70 basis points over the past month. Actually, it's more than that now. And it's 2 percentage points higher than a year ago. So they have increased more than 2 percentage points in just 4 short months. And because rates have increased greatly, of course, the refis have been decreasing as well, decreasing for the 6th consecutive week. However, it has this to say. In a housing market facing affordability challenges and low inventory, higher rates are causing a pullback or delay in home purchase demand as well. Home purchase activity has been volatile in recent weeks and has yet to see the typical pickup for this time of the year. So again, this is April. This is during the time where our housing market tends to just go off the handles. It tends to be a time where a lot of people are submitting loan applications. We're seeing a lot of home sales, but we're not seeing that. We're actually seeing a decrease in the number of people submitting loan applications right now versus a typical increase during this time period. Again, this is a concern I have, but here's another concern I have as well, because as I've been reporting to you guys for months now, I've been seeing more and more home buyers submitting loan applications using ARMs, adjustable rate mortgages, and not 30-year fixed rate mortgages or 15-year fixed rate mortgages. So it says here, the ARM share of applications reached 8.5% last week, the highest level since 2019. As ARM loans typically have lower rates than fixed rate mortgages, and as this spread has widened, ARM loans have become more attractive to borrowers already facing home purchase loan amounts close to record highs. If you guys aren't familiar, an adjustable rate mortgage is a shorter term product where your rate and housing payment remains fixed for a shorter period of time. You can get a 5-1 ARM, a 7-1 ARM, or a 10-1 ARM, for example, where your rate is fixed for 5 to 7 to 10 years. After that time period, though, your mortgage rate becomes variable, meaning it adjusts to current market conditions or current rates. So therefore, after that set period of time where you have a fixed rate, your mortgage payment could potentially increase greatly if mortgage rates have also increased as well. So in my opinion, this is a big risk, especially people looking to buy a house right now using only a 5-year fixed mortgage and then variable thereafter. So again, for the week ending April 15th, 2022, the share of loan applications right now reached 8.5%, and that's the highest level since 2019. And here's the reason why people are doing this. So the average right now for a 30-year fixed rate mortgage is 5.2%. according to the Mortgage Bankers Association, again, for the week ending April 15th. However, when you look at the rates for 5/1 ARMs, for example, the average rate is 4.09%. So buyers are looking at high home prices and also really high mortgage rates for 30-year fixed rate mortgages at 5.2%. And they're looking at, hey, I can just buy a house using a 5/1 ARM, and my payments can be a lot less because the mortgage rate is only at 4.09%. So why not just buy a house using a 5/1 ARM right now rather than a 30-year fixed rate mortgage, because I can afford more house, and of course my housing payments can be a lot less. So let me give you a brief example here. So this is according to the Mortgage Bankers Association again. So again, right now, as of today, which is the 21st of April, the average right now is 5.38 for a 30-year fixed rate mortgage, compared to a 5/1 ARM. Again, you can get a 7/1 ARM or a 10/1 ARM, but if the rates for a 7/1 ARM or a 10/1 ARM actually would be a higher rate. So the lowest rate you can get for a ARM, or the averages, I should say, and by the way, these are for people who have exceptional credit. These are the best rates you can get on average. So right now, the 5/1 ARM is 4.25%. So when you look at basically a loan amount, let's say of $400,000, your payment of principal and interest only for a 30-year fixed would be $2,241 per month. However, for a 5/1 ARM, your payment is just under $2,000 per month. So in this example, again, with a $400,000 loan amount, you would be saving $271 per month in principal interest payments. And that's one reason why people may be moving to a more risky, in my opinion, adjustable rate mortgage. What's also concerning me is that the trajectory of how fast this share of people using adjustable rate mortgages is. So again, right now, 8.5%, but compared to last week, or for the week ending April 8th, the share was actually only at 7.4%. So we have gained 1% in 1 week, which is pretty remarkable. But have a look at this, because this is super important. So for the week ending January 7th, 2022, so basically at the start of this year, the share of ARMs we're only at 3.1% of total applications. So basically at the start of the year, we were at 3.1%. Now we're at 8.5%. So the trajectory has been increasing greatly. And one reason for this is that the spread between the difference in rates between a 30-year versus an ARM has been increasing. So basically at the beginning of the year, the average for a 30-year rate was at 3.52%. The average for a 5/1 ARM was 3.03%. So about a 0.5% increase for a 30-year rate versus a 5/1 ARM, which makes sense that we're seeing fewer people doing ARMs if the difference is only 0.5%. However, for the week ending April 15th, 2022, the spread, of course, has been increasing. The rate for 30-year was 5.2% versus a 5/1 ARM at 4.09%. So basically at the start of the year, that spread was only 0.5%. Now it's over 1%, causing more people to move to adjustable rate mortgages, which in my opinion is a big, big risk. Yet another trend that I'm personally following that I'm also concerned about as well is a decrease in the number of home showings by real estate agents across the United States. So as you can see, this is the National Association of Realtors Central Lock Home Showings Report. What this report basically is about is realtors showing houses to their home buyers. This is the most recent data that we have. This is actually just published a couple of days ago. Here's what I personally follow. This is the showings per card. That's a measure of the intensity of demand and buyer competition that actually decreased 17% year over year. So basically the showings, of course, is when a real estate agent shows their home buyer a house. And think of a card as every house listed for sale has a card, and they have a lockbox in which real estate agents access. And when they access that, Central Lock tracks that. So showings per card decreased 17% compared to year over year. We're starting to see this decrease in that trend though, and that could be a sign that home buyer demand is decreasing. Yet another trend that I posted about a couple of days ago was the fact that the National Association of Realtors, or NAR, they reported that existing home sales fell 2.7% in March to an annual pace of 5.77 million home sales for the entire nation here. It says here, this is according to the Mortgage News Daily, a really good article they just posted yesterday. They said 5.77 million. Again, this is the annual pace. is certainly well below the post-COVID highs of 6.65 million, but notably higher than any pre-COVID month going back to 2007. In that sense, we can continue to entertain resilience in the purchase markets. But even NAR's chief economist Lawrence Yun had this to say because he expressed some concerns here. The housing market is starting to feel the impact of sharply rising mortgage rates and higher inflation taking a hit on purchasing power. In this report here from the Mortgage Bankers Association, they basically said this is a fair assessment to say that because mortgage rates have been increasing greatly, and of course because inflation is at sky-high levels at 40-year highs, that may cause home buyer demand to decrease. But they're basically saying it's too early to tell regarding that. But have a look at this. This is a chart showing a few examples of rate hikes compared to home sales. So back in 2013, we had an increase in mortgage rates right here in green. So the green line here is mortgage rates. The blue line here is existing home sales. So the total number of home sales in the US versus the average 30-year fixed rate mortgage in green here. Have a look at this. So when rates increased back in 2013, 2014, the number of home sales actually decreased. So back in 2017, mortgage rates also increased, but also home sales increased as well. So we didn't see a correlation with rising mortgage rates and decreasing home sales. That did not happen in 2017. However, in 2018, we did see that though, because in early parts of 2018, rates were approximately 4%, and the end of the year at approximately 5%. So approximately 11 to 12 months, mortgage rates increased about 1% in 2018. That actually caused a decrease in home sales during that time period. So what we're seeing right now, though, is mortgage rates increasing greatly. I mean, look at this. Almost at 3% at the start of the year, and now we're over 5%. The biggest increase we've seen in many, many, many years, probably going back to 1994, if not earlier. But we're seeing this big increase in mortgage rates. So we're starting to see a decrease in home sales as well. So we'll have to see if this trend continues, especially as we go into the summer months, because if we're starting to see home sales decrease in the late spring months and summer months, that would be a clear indication to me that home buyer demand is decreasing. However, one wild card that I definitely want to bring to your attention though is housing inventory. So of course right now, housing inventory is near all-time record lows, and that could impact or cause upward pressure on home prices even though mortgage rates have been increasing. So have a look at this. So back in, again, 2018, when mortgage rates increased approximately 1%, in the span of about a year, home sales decreased, but housing inventory during that time, we had approximately 4 months of housing inventory. Now we have approximately 2 months. So approximately half as much inventory now compared to 2018. However, of course, mortgage rates increased approximately 1% for the entire year of 2018. And now in approximately 4 months, mortgage rates have increased about 2%. So a much bigger increase in mortgage rates. We'll have to see how that's going to be impacting home buyer demand in the months to come. So comment below with your biggest takeaways from today's video. Also, if you got any value out of today's video, then please hit the like button. I greatly appreciate that. Also, consider subscribing if you haven't done so already. Hope you have an awesome day. Look forward to seeing you in the next video.